gold adjusted for real inflation. This is the way that inflation was calculated by the US government in the 1970s. Then, if you adjusted for that, the gold price of 1980, which was 850 at the high in 1980, that gold price today would be $38,000. $38,000. And that is actually not a target, as I said earlier on. That is just coming back to the inflation adjusted level as it was in 1980. And in this coming era now, it could happen very quickly or it could take a few years. We will see at least that price in paper money and probably a lot more because, as I said, there'll be massive amounts of paper printed.
You generally have 6 to 8 weeks in that direction. I believe that we will probably see in this move, gold at least pushing the old high, and I would think you'd see silver probably in the 90s or pushing $100.
Gold's value is now being assessed for its long-term store of value rather than short-term price movements. The main takeaway is that gold's strategic role is increasingly seen as preserving purchasing power over time. After adjusting for inflation, gold prices remain well below significant historical benchmarks. The main takeaway is that there is room for further price appreciation when considering real inflation. This change in perspective is leading market participants to reconsider gold's long-term value, showing that market expectations are being reshaped by these developments. Egon von Greyerz, a global wealth preservation expert, and Bill Holter, a respected macro analyst focused on monetary systems, explained that the 1980 gold peak of $850 translates to nearly $38,000 in today's dollars when measured using 1970s inflation standards. They emphasize that this is not a speculative target, but a reflection of the purchasing power fiat currencies have lost over time. With ongoing monetary expansion and rising debt levels, they see a strong case for significantly higher gold prices ahead. In the near term, technical signals suggest momentum is building, with gold likely to push toward previous highs, while silver could move into the $90 to $100 range. They also note that such moves can unfold quickly, often within a 6 to 8 week window once momentum confirms. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Gold will reflect all the problems that are coming. A potential target could be $38,000. It's not a forecast, but I will talk about later in this video how we get to that. Now, look at first what happens to inflation and interest rates at the end of a monetary era that we are in right now. Interest rates have gone from 16%, that's measured on the 10-year US Treasury bond. In 1980, there was 16%, and it was down to 0.5% in 2020. Now we're just over 4%. My forecast, as this graph shows, is that we are going to go above the 16% in the 1980s. I think we could overshoot it by a big margin for the simple reason that inflation will be higher than it was in the 1970s, and there'll be many more defaults than we saw in the 1970s. And I would expect in this coming era that we also see sovereign defaults. The US will definitely default in one way or another. Doesn't mean that they go bankrupt, but it means that the currency will go to zero and the money printing will be unlimited. So that virtually will lead to US Treasury bonds being worthless, and therefore interest rates could even go a lot higher than the 16 to 20% that we saw in the 1970s. It could go a lot higher even. Now, of course, people will suffer dramatically with these high interest rates. I saw just a recent article, fishermen in the North Sea. It used to cost them £5,000 to go out with their boat to fish haddock, and now it's up to £10,000. It's doubled in a very short period of time. That means higher prices for consumers, lower income for the fishermen, and losses within the system. And that's just one example. It will happen throughout the system. There'll be massive inflation and there will be misery because people cannot afford the higher prices, and all governments can do is just to print more money and make the currency more worthless than it is now. And it's, as we know, and I talked about many times, already gone down by 99% since 1971. That is against gold, dollar, euro, yen, etc. And they've all gone down 99%. and it's only 1% left. So this will just not have consequences for markets, bond markets, that will, as I said, crash, but also for stock markets. Stock markets are now starting a major downtrend. Before this is over, I see the Dow Jones and the Standard & Poor's go down by 90 to 95% against gold. And gold is really only measuring in real terms. So if you look at the graph here, it shows how we've already gone down 75% since 1999. That is, the stocks or the S&P has gone down 99% versus gold since 99. Now, from this level, I expect another fall of 95% before this era is over. And that fall could happen very quickly. It could take a few years. And then after that, it goes along the bottom, maybe for 5, 10 years or longer. So this is a massive shift from paper assets to real assets. And anyone who gets caught with the paper assets and does not shift into real asset is going to lose all their wealth in coming years. I repeat, you are going to lose all your wealth if you don't shift to real assets. And that is not a joke. That is absolute reality. And please don't wait for the market to recover before you sell. Sell now. Sell before it reaches the low levels. You can never sell at the top. Now is a good time to sell. Now is a good time to switch to gold. Remember, so gold is going to go up substantially, but that is measured in dollars or in euros or in yen. But actually in real terms, gold is not going up. It's never gone up. Gold maintains stable purchasing power. I've looked at the ratio between a cow and gold. You know, since we can't measure gold in money terms because money goes down in value by the day, why not measure it in something real that everybody consumes? That is, for example, a cow. And over the last 5,000 years, a cow in gold terms has cost between around half an ounce of gold to just over 1 ounce of gold. That is quite remarkable. Think about that. Cow has not gone up by more than half an ounce of gold maximum over a 5,000 year period. It shows you that when you look at your wealth in paper money, it's absolutely the wrong measure to use. Think about instead money in real terms. Think about money in gold terms. That's the only way to measure your wealth. So what is the consequence of this? Of course, the consequences are dire. It'll be collapse of the financial system. It'll be a collapse of the many banks, maybe the majority of the banking system. It'll be restructured at a massive cost. There'll be collapse of the bond market and of course of the stock market, as I said, and times will be very tough. So in money terms, which as I said is not the way you should measure gold, you should just take gold as stable purchasing power. But if you want to look at it in money terms, because you should, because if you keep your money in currencies, in dollars, in sterling, pounds, or in yen, then you're going to lose all of your wealth. But if we measure it in real terms and adjust it for inflation, gold adjusted for real inflation, this is the way that inflation was calculated by the US government in the 1970s. Then, if you adjust it for that, the gold price of 1980, which was 850 at the high in 1980, that gold price today would be $38,000. $38,000. And that is actually not a target, as I said earlier on. That is just coming back to the inflation adjusted level as it was in 1980. And in this coming era now, it could happen very quickly or it could take a few years. We will see at least that price in paper money and probably a lot more because, as I said, there'll be massive amounts of paper printed. So please buy gold, buy physical gold, store it in a safe place, in a safe jurisdiction outside the banking system. Also buy some silver. Silver is now massively undervalued and is likely to go up a lot faster than gold for quite a time.
Gold is increasingly viewed as a signal of stress in the global financial system. The main takeaway is that its rise reflects inflation and systemic risk, with a shift underway from paper to tangible assets. Rising interest rates, persistent inflation, and expanding sovereign debt are creating conditions similar to those of the 1970s, but potentially more severe. The outlook points to higher volatility across bonds, equities, and currencies, with the possibility of significant declines in traditional financial assets relative to gold. At the same time, continued money printing and structural imbalances could accelerate gold's repricing, while silver remains positioned to outperform due to its relative undervaluation. This environment suggests a prolonged shift in capital flows, where preserving purchasing power becomes the dominant priority over nominal gains. Let's get back to the interview.
Gold and silver got oversold for the first time in a year or over a year. We marked bottom back on 2 Monday mornings ago. Not this past week, but the week before. Gold got down to literally 4,000 and silver got down to about $61. I do believe I called bottom late last week on both gold and silver, and I did post on posted early in the week, and then I posted again on April 2nd, where you can see the MACDs got very deep into sold territory, and they have now, as of a couple days ago, but today confirmed it, they've crossed over to the upside. This is not, carved in stone, but generally when you see the MACDs either cross over to the upside or roll over to the downside, you generally have 6 to 8 weeks in that direction. I believe that we will probably see in this move gold at least pushing the old high, and I would think you'd see silver probably in the 90s or pushing $100. And obviously the late afternoon sell-off in markets and silver and gold had to do with the ceasefire being broken. And I just want to say this, it is totally, gold and silver are trading, if you want to call it, wrong. Because think about this, let's say that all hell does break loose. What do you want to own? Do you really want to own a piece of paper that's issued and backed by an insolvent entity? Or do you want to own real money that can and will be accepted anywhere all over the world? Gold and silver should be gobbled up when things get hot, but that's not what's been happening. What's been happening, gold and silver are acting like a risk on asset as opposed to a risk off asset. And I'm just going to say that gold and silver are the ultimate risk off assets. Let's go back, because the last time I was with you, we talked about the March delivery cycle, which I don't know, it's suspect to me, because we had 50 million ounces in January, a non-delivery month. We had 25 million in February, another non-delivery month. And then we started March with 52 million ounces, but ended up at 42 million ounces. And I believe that is this past March was the first month in 2 or more years where what stood for delivery on day one ended up being less on the final day. For the last 2+ years, and I'll just use the number of 100, if there were 100 ounces standing at the beginning of the month, by the end of the month, every month for 2 years plus now, it's gone to 120, 150, 200. There's always been more gained during the month. This is the first month where there was actually less standing at the end of the month. And very interesting that one day the CME actually stood, the exchange itself stood for delivery. And you would have to ask why. And the only thing I can come up with is there's no way to know whether that was delivered or not. There's no way to see. So did they hide a delivery that couldn't be made? I don't know, but that's the only thing I can come up with. Well, what happens is you have contracts that are open at the beginning of the month, and then they go away. They get sold. But what's happened for the last 2 years is you have contracts open at the beginning of the month, and then there's more and more that gets piled on, or has been for the last couple of years. So every delivery month, or every month, even non-delivery months, whatever was open and open at the beginning of the month, that number increased and more stood for delivery than what the initial first notice day was. And this is the first month, like I said, in a couple of years, where there was actually less that stood for delivery than was opened on the first day. When a war starts, gold and silver get sold. That has been the pattern since 1991, since the Iraq War. Gold and silver got weak after that. Gold and silver got weak after the the second Iraqi
Mhm.
war.
No, 03, yeah.
But prior to 1991, whenever there was any type of bad news, gold and silver got bought. I mean, go back to the Afghanistan experience. That was in the late 1970s. And gold would trade up on any type of bad news with the Russia against Afghanistan. Gold historically, like up until the 1991 episode, gold historically, whenever it looked like there was bad geopolitical events happening, gold was bought. And once they figured out in 1987 that they could wag the dog with paper contracts, the contracts wagging the physical price, once they figured that out, everything has become, if you want to call it, locked down. The prices are, they learned that they can actually move and control price with paper contracts. And that's what they've done. And that's what has happened for the last 30 years. Now that will break, because I guess the best way to say it is, what's the value of a contract that cannot perform? The answer is zero. And COMEX and LBMA are going to become irrelevant versus the cash markets worldwide.
Gold and silver have entered a critical phase after reaching deeply oversold levels for the first time in over a year, signaling a potential turning point in momentum. Technical indicators, particularly MACD crossovers, now suggest a shift to the upside, historically pointing to a 6 to 8 week move that could push gold back toward previous highs, while silver targets the $90 to $100 range. Despite short-term volatility from geopolitical events, the main takeaway is that shifting delivery patterns and growing pressure on paper pricing could realign price discovery. If imbalances persist and physical demand increases, market valuations of gold and silver may be significantly altered. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.